I'm Tim Sustak, Chief Credit Officer with Vizo Financial, and this is your FOMC update for March 2021. The markets waited in anticipation of the March FOMC meeting, not so much because it was thought of a rate change, but for guidance as to the committee's view on economic growth, inflation, and the timing of future rate moves. As expected, the Fed maintained the current Fed funds target range at a level of 0 to 25 basis points, as well as the rate on required and excess reserves at 10 basis points. Further, they maintained their commitment to increase holdings of Treasury securities by at least $80 billion per month and agency mortgage-backed securities by at least $40 billion per month. The post-meeting statement changed very little, with the committee now simply saying that indicators of employment and economic activity have improved recently, that sectors most hit by the crisis remain weak, and that inflation continues to run below their 2% target. More importantly, it's the end of a quarter, so we got another peek at the Fed's economic projections. The focus is on a dot plot, or the Fed's expectation for future rate increases. The median expectation did not change given that 11 of 18 participants still expect the Fed funds rate to remain unchanged through 2023. However, as opposed to December's projection, 4 participants now see a rate increase in 2022 instead of 1, and 7 now see an increase by 2023 instead of 5. So, the projection changed to some degree in favor of an earlier rise in rates. We'll take a look at what Chairman Powell had to say at his press conference after the break. Welcome back. The chairman's press conference after the meeting addressed many of the same topics that the Fed has addressed throughout the crisis. The chairman did give an update on employment, indicating that labor market activity has improved recently, adding 379,000 jobs in February, with the leisure and hospitality sector recovering about 2/3 of the jobs lost in December and January. He also noted, though, that the sector is still down over 3 million jobs from where it was at the start of the pandemic. Regarding inflation, the chairman said measures will rise in the coming months, particularly because the low readings from March and April from last year will be removed from 12-month calculations, but also as inevitable bottlenecks happen as the economy opens up and the supply side may temporarily not be able to meet demand. He stressed, though, that the committee views these inflation pressures as transitory and not of the persistent variety the committee is looking for regarding a change in monetary policy. Watching the question and answer session after the chairman's prepared remarks, it's very clear that everyone wants to be in the business of trying to predict when the Fed will remove policy accommodation, but the Fed itself. The chairman made it clear more than once that the committee is looking for 3 things: labor market conditions consistent with the committee's estimate of maximum employment, inflation that has reached 2% and not on a transitory basis, and inflation that is on track to run moderately above 2% for some time. When the committee sees that data, it will react with adjustments to monetary policy, which he indicated will be clearly communicated well in advance. Though we all want to know when the Fed will adjust monetary policy, what they're trying to tell us is it's worthless to try to predict when it will happen because no one knows, not even the Fed, until the data they are monitoring dictate that a change should be made. That, in essence, is the difference in this new Fed versus those of old. This Fed will not try to predict what is going to happen and preemptively act, but will let the data tell the story and react accordingly. Try as we may, it will be tough to decipher what is going to happen before the Fed and the data are willing to tell us. That's the FOMC update for March. Thanks for watching, and be well.